everybody. Good afternoon. My name is Ted Farrell. I'm your host for all things litigation funding. We have two outstanding guests today who have given us their time here. Really happy to have them. Stewart, Ackerly, and Blumenstein from Statera Capital. Guys, could you do a couple quick introductions here? And we're going to go reverse alphabetical order here because I see that Matt is in the number 2 slot on our split screen. So just a little background on you, and then we'll sort of get into it.
Sure. Hey, Ted, thanks for having me and us on. Excited to be here. My background, surprise, surprise, is in litigation. I went to Stanford undergrad, Vanderbilt Law School, and then clerked on the DC circuit after law school, and then stayed in DC and went to work at the law firm of Williams & Connolly, which is a litigation-only firm, single office in Washington, D.C. that does sort of high-stakes civil and criminal litigation all over the country and the world. And still, at least during my time there, it's still subscribed to more or less a generalist model. So we weren't in practice groups, we weren't assigned specialties, or didn't choose specialties. So got a wide range of experience in civil cases, some criminal work as well, and within civil cases really ran the gamut across subject matters and claim types and jurisdictions and even plaintiff and defendant. So I did predominantly civil litigation at Williams & Connolly for 10 years. And then during COVID, like so many people, I changed gears and moved back to my home city of Chicago with my wife and daughter to join Statera, which was just starting to invest. Chip and Andy, the founders, who we'll tell you about more, had raised the first fund and were ready to start investing, and they wanted to hire somebody to take the lead on the underwriting. And I got that job and moved back to Chicago, peak COVID, August 2020, and started working at Statera as the head of underwriting, and also with the general counsel hat as well, or deputy general counsel hat.
Gotcha. Stewart?
Yeah, thanks for having us, Ted. A similar background to Matt, at least with a couple key parts. I went to UVA for undergrad and law school, and after law school, clerked on the DC circuit for the same judge as Matt a couple years after him. And
so
then
we officially have a feeder judge for litigation funders in Chicago now? Is that what you're saying?
You don't even know the whole story.
Well, we'll get into that. We have time. We have time. Come on. No, I'm just kidding.
Yeah, my co-clerk is also in the business at CAC Specialty.
Gotcha.
And after clerking, followed Matt to Williams & Connolly, where I was for a little over 5 years. I focused generally on civil litigation and international arbitration. And then I went into the government for a few years working at the U.S. Trade Representative's office, negotiating the new NAFTA, the USMCA, and then to another finance agency called the Development Finance Corporation, which is essentially a $60 billion investment bank owned by the government that finances infrastructure projects overseas. And then when I came out of the government, was trying to figure out what to do next, and litigation finance conveniently combined two of the things I spent a lot of time doing, both litigation and then finance, which I've done a lot of in the government. And Matt, I was just generally talking with Matt about job search stuff when I was coming out of the government, and what is LinkedIn and how does one use it? And then Matt mentioned one day that Andy and Chip are looking to make their second hire. They were focused on a BD role, and I thought that could be really exciting. And here I am about 3.5 years later, still with it.
Cool. All right, guys. So tell me, because I think this will be interesting. I know when Chip and Andy started, they saw sort of a niche within the market, and you guys tend to play in a little different space. So, I'll sort of throw the floor open here. What is sort of the sweet spot for an investment that you guys would look at and get involved in?
Yeah, so you nailed it in that Andy and Chip had this realization and recognition that in the commercial litigation funding space, most funders were focused on really large financing needs, and kind of $5 million or $10 million plus for a single case, or even larger portfolio opportunities. And if you talk to Andy, his practice at McGuire Woods included some of those types of cases, but also included a lot of smaller cases that had $1, $2 million, $3 million budgets with 10, 20, 30, 40, $50 million at stake, but they just weren't of interest to most of the mainstream litigation funders because they had moved on to bigger opportunities for various reasons that were all kind of reasonable.
And it's understandable. You raised $500 million. It's hard to chunk it. And no, I mean, that's totally, I mean, I get it. It's neither good nor bad, but I mean, that's just,
it just kind of is what it is. I mean, if you've got $500 million, it's going to be easier to put that into 10 cases than 100 cases. And so, seeing that, they set out to start a fund that would focus on kind of middle market commercial disputes. So, we are still doing that to this day. So our sweet spot is any commercial case that needs $500,000 to $4 million in funding. And that covers mostly single case financings, but we have also doing portfolios with law firms and with companies. And I think we still hear in the market that there's a growing and large need for funding in that segment, that most of the funders out there are still focused on the larger stuff. And we've just found there to be a lot of receptivity and use for that kind of middle market size financing amount.
Got it. Okay. So here's something I try to ask everybody, because I think this sort of sets the table is, and again, you guys can go whatever order you want, but what was the first funding deal you were exposed to or saw, or, were you in private practice? Was this what was your first sort of exposure that this even existed?
To my knowledge, none of the cases I worked on at Williams and Connolly had, certainly not on my side of the case, none of them had funding. And to my knowledge, none of the other side had funding. And, there was, I read more and more in Law 360 about funding conceptually, but not particular specific cases. With the exception, I suppose, of the Hulk Hogan case, which seems to come up every time anyone ever mentions litigation funding, but it's utterly.
By the way, he did win that case, right? He did win that one. That's something that nobody mentions, right? He got a good judgment there too.
Yeah, much to the chagrin of Gawker and its millions and millions of fans. So the first time I ever was exposed to an actual case that required funding was actually in trying out for my job at Statera as part of my interview and application process. Chip and Andy gave me a real live case to underwrite as a sort of tryout, and I think they did with a handful of other sort of shortlist applicants as well. So that was the first time that I ever had exposure to a litigation funding case was in my job application in a real life environment.
Interesting. And Stewart, how about you?
Mine was coming out of law school. I had a bunch of friends go to work for what was then Patton Boggs in DC, and
they were in Chevron, Ecuador.
They were in that Chevron case in Ecuador. That
went great, right?
It worked out really well for the firm. They ended up merging with Squire. We're now Squire Patton Boggs.
Wow. Were they the target? I'm guessing they were the target.
Yeah. Admittedly, I had a little bit of a skeptical view of funding, and I think when I was talking to Matt in some of my initial conversations with him about funding, I did have this moment where I was like, "Is this allowed? Is this okay?"
Right.
Yeah.
Okay. So you got over that apparently.
In spades. I mean, it's worth sticking there.
And by the way, I think and I think one thing is important. Like, it's always the blow-ups, right, that get the that get the attention, and I understand why that is, because the blowups also tend to become public. But yeah, Matt, I'm sort of, and I would say this, like, you guys, given that you clerked on the DC circuit and with your backgrounds, like, it's not like you're here because there's nowhere else, like there's no other seat for you in the business, right? And I would say that I don't consider either of you to be, officious intermeddlers or, Jampertist people. No, for real, right? And so, coming from sort of like, I mean, like I'll say, like kind of like you both have real pedigrees here. And I think that's sort of an important thing for people to understand. So Matt, why don't you just give us a little bit on that?
Yeah, I mean, so, I learned about champerty in law school and officious intermeddling and the like.
That's the only kind, right? Inofficious intermeddling is fine. It's the officious kind. Yeah.
And then was sort of increasingly aware of funding, but didn't know much about it as it gained prominence in the sort of legal ecosystem over the course of my time in private practice. I was almost always on the defense side, sometimes on the plaintiff side, but mostly I was a defense lawyer and a zealous defense lawyer. So when I was presented with an opportunity to enter this industry, I'm not exaggerating or embellishing by saying my first and threshold question was, is this a socially positive tool? Is this a socially positive industry? Is this a socially positive project that I'm considering embarking on? That was the first thing I discussed with Andy. I talked about it with others, with lawyers, with lawyers who had interacted with funding and were smarter about it than I was. And that was an absolutely critical consideration. And Stewart, I remember, had the same sort of process. And I believe that it is. I believe that it is a socially positive innovation in the legal market. I believe that it does facilitate access to justice for people and companies that wouldn't otherwise be able to afford it. Typically, I think access to justice is rightly associated with criminal matters, but there are really upsetting and unjust stories about especially small companies getting screwed over by big companies, and with limited ability to seek, just redress. And oftentimes big companies do it on purpose, exactly because they know that the small company is unlikely to be able to pay for good lawyers and litigate for 3 years and spend millions of dollars in order.
We're going to talk about duration.
We'll talk about that later.
And I wish it was.
I believe it is socially positive, and we have I have the emails to prove it. I've had more experiences in this seat where I get heartfelt, appreciative emails at the end of a matter, thanking me and us for enabling justice than I did at my old job. The closest analog would be, the pro bono work I did back then. And of course, we are not pro bono. We are very much profit motivated, but we really do serve, I think, oftentimes, if not always, a very socially positive role.
Right. No, I think that's, I do think that's is important for people to hear. Some don't want to believe it, but that I think is totally fine.
And the ones who don't want to believe it, candidly, run the risk of hypocrisy, because at this point, virtually, maybe literally every law firm is engaged with litigation funding. I don't care how white your shoes are or how close to the helipad your office is in Manhattan. Chances are somebody in your building is availing itself of litigation funding. And, it's not uncommon for Fortune 10, 20, 50, 100 companies to fund affirmative recovery programs with litigation funding. So there are really very few folks who aren't benefiting from this, even if they're also simultaneously funding the Chamber of Commerce's crusade against it.
Right. And so I guess that sort of piggybacking on that, you know, I was going to sort of ask you, like, what do you think are some of the, you know, misconceptions out there, but maybe more some of that, like, what has surprised you? So obviously when you guys came in, this is really meritorious, and it's you know, for all the reasons. And look, there's reason people take this financing is because it is their best avenue to get redress. But what is sort of like surprise? Because I guess you guys have now been at this for 3 or 4 years each, right? So like, what is sort of like surprised you or like stood out to you that kind of didn't, you know, hit you like when you first started? This is what it was going to be like.
First thing that comes to mind is how bad lawyers are at damages, and yet how critical that is to what we do. I'd say, you know, because we focus on the middle market, as Stewart says, getting damages right and getting collectability and sort of firming up collectability are just essential and are a huge part of what we do. The merits part is candidly more my strength, and that's reflected. I mean, most lawyers, I think, in big law or law school or whatever, aren't taught how to do, you know, net present value damages analysis based on discounted future cash flows in order to determine what the realistic range of damages will be when the expert put in their reports and get deposed. In fact, I think that most big law lawyers worry about that when the time comes, particularly on the defense side, but to some extent on the plaintiff side too. You kind of have a sense that there's enough value there, and it's for the experts to quantify it eventually. But we have to underwrite cases rigorously and quantitatively, and we have to defend our underwriting to our investors at times. So we need to have a defensible and rigorous view of what the damages are and and therefore what the resolution value of the case is likely to be. And to this day, that is the biggest weakness of the counterparties and potential counterparties we interact with, and that's the hardest thing we do. And I certainly wouldn't have known that, I don't think, on the first day I walked in.
Right. And Stewart?
Yeah, I mean, I'd have one gloss on what Matt was saying, which is that I think some of it's just, especially, I think we see this with larger firms in particular, that with lawyers that maybe don't have as much plaintiff side experience, but
or
just,
any.
Yeah, or any.
No, sometimes, right? I mean, or any, for real, yeah.
Trying to think about the value of litigation and kind of a cost to value analysis. I mean, I'm always amazed when someone will pitch us on a case and they'll say, yeah, it's a, you know, $10 million top line recovery, and we've got a $5 million budget. And you kind of just want to look at them and say, what planet does that make sense from an economics perspective for your client? Maybe it makes sense for you.
So here's another one, and this is sort of, I'm gonna make an analogy here. It's sort of like if your job was like you worked at a movie studio and you're reading the spec scripts, right? How much do you guys follow the no's, right? So we took a look at this, and we said no, and do we follow it? And then more importantly, is it necessarily, do you think it's a bad thing when there's stuff you said no to, but maybe that paid off? I'm just sort of, you know, interested in that kind of stuff.
So I, in addition to being in charge of underwriting, I'm also in charge of monitoring. And I do a ton of this, not because anybody ever said that I have to, but because I really want to see how cases turn out. I want more and more data. So anytime that we look closely at a case, I will sort of set an alert and keep it on my radar and follow it. I don't follow it day to day like I do the cases that we're invested in, but I follow it. I follow, I think, roughly 100 cases right now, including the ones we're invested in and ones that we thought hard about. And it's really valuable. Why wouldn't you? I mean, I guess one reason is there's only so many hours in the day, but it's just valuable data to see what happens with the cases were you right for the reason that you passed? If, God forbid, it was a case you wanted and you didn't get it, did you miss out on an opportunity, or did you dodge a bullet? So I track a lot of those, and it's usually confirmatory, gratifying project. There's one I can think of in particular where I remember arguing with a lawyer for hours about whether they were going to be able to get lost profits, and we passed. And then like 2 years later, there was a summary judgment motion about where the defendant was arguing the lost profits were not available as a matter of law, and the defendant won. And I was I was glad that I stuck to my guns on that. So that can be really interesting.
Yeah, but interestingly here, and this is why I think it's a fascinating business, is, they could have made the same arguments and maybe it was a 2 out of 10 they were going to win, but they got the right. So in other words, I guess what I'm sort of saying is you can say no for the right reason, even though in fact,
I think 1,000%. I read books about this stuff, and one of the authors I like calls it resulting. Just because something wins doesn't mean it was a good investment, and just because something loses doesn't mean that you made a mistake. And I think we as a firm really take that seriously. And when cases have gone sideways, no one's ever, we look back, we do a sort of post-mortem on our analysis and our underwriting, but it's about the process and the soundness of our process ex ante. It's not based on the result. We're sophisticated enough to know that a bad result doesn't mean it was a bad decision. That's 100% right.
Yeah.
And also, it hurts more to, it's never a ton of fun to see a case that you pass on be successful, but it's more fun than seeing a case that you didn't pass on lose. And the other thing about this, Ted, which is a frustration.
Hang on, Matt. That should be your next book. Forget resulting. That's the book. That's the book I want to take. Maybe an ebook. Just make it available.
Well, I think it's pretty well understood in the psychology of gambling that losing is more painful than winning is pleasurable. Another thing is, and a great frustration of this industry, and in my view, a limitation. When people are talking about using big data to use artificial intelligence in order to do litigation funding, is you don't know what the settlement was for.
Of course.
I mean, oftentimes we'll follow cases for a couple of years and then you see the, stipulation of dismissal, and it's like, hey, the Acme case settled, but you have no idea if it settled for a nuisance value because the plaintiff realized that they had major problems, or if it settled for something that would have justified funding. So oftentimes you never get a satisfactory answer to whether you should have done a case or not, because settlements are confidential. The settlement values, that is, not the fact of settlement, but the settlement value. Just because something settles doesn't mean you missed out. In fact, in the instances when we have found out what matter is settled for that we had passed on, oftentimes it's at a number that substantiates our decision to pass on the basis of value. I mean, we pass on value and collectability, I think, probably more, if not much more, than merit. Don't you think, Stewart?
Yeah, I'd say damages and collectability. And I've had multiple cases where I've sent, where we passed on a case, and then a year or 2 years later, we see a headline in Law 360, or we get a docket update that they got a jury verdict for tens of millions of dollars. And I mean, as I always tell the lawyers on those cases, I'm very happy to send the email to them saying, congratulations, what a great outcome. But I think we trust our process enough to know that, there was obviously some chance that case could win. Otherwise, we wouldn't have spent as much time as we did on it. But just because there's some chance it could win doesn't mean we should finance it. Like, it might have been, like I said, a 30% chance, and they got just the right judge and just the right jury, and it worked out. But do I regret that we didn't finance it? No, we made the right decision kind of ex ante.
Yeah. Well, look, I don't want to tell you how to do your job, but you're in BD and Matt's an underwriter. So what you're supposed to say is, Matt totally killed this thing, and if it was up to me, we would have done that. Like that's free advice. But I'm just saying right now, like Matt doesn't know what he's talking about, and he's probably not going to be here for that long. We'd love to see what else you got. That's what I would say. That's up to you.
Well, and let me actually say something that is a corollary to what Stewart was just saying, and I think it might be kind of a misconception about funders. We don't expect 90% or 99% of our cases to resolve successfully. If you did that, I think you wouldn't close any deals. And Ted better than I do. That's the thing. Funder raises a fund and then doesn't do any deals because they're trained to issue spot and they don't want to take any risk.
Right.
Stewart started mentioning percentages there. We underwrite to percentages, and some of our deals are gonna lose, and that's why we get paid healthy returns on the ones that.
And they're not going to lose because they're not meritorious, but it's only 78% because there are arguments the other way. So I get so like, but I want to sort of be clear here, like. Some would say, I heard this podcast and they said they're funding some non-meritorious cases they know we're going to lose. And I don't think that's what you're saying. I think what you're saying is litigation is uncertain and, good cases can lose, right? I'm just saying, but that's sort of how I look at it.
1,000%.
Yeah.
And there's necessarily uncertainty. So think about this on a spectrum. The insurance industry has a closed record and a judgment, right? Either a jury verdict with a trial record or a reasoned opinion by a Article III judge or a state court judge. They have all the information that the appellate court is going to have. And they have really smart people working there. And, my understanding is they look for something like 90% certainty, maybe higher, and they lose. We all know that they lose. It's pretty famous. So that's with perfect information and a bunch of really smart people, all but guaranteeing it's insurance after all, that the case is going to be affirmed, and then it goes the other way. So that's really hard, right? Now think about the fact that we do a lot of our cases at the complaint stage. Maybe the complaint hasn't even been filed. We don't know what the defense is going to say legally. We don't know what the defense is going to say thematically. We don't know what the facts are going to be in discovery, what documents are going to come up. We don't know who the judge is, and if the judge has a personal predilection against certain types of claims. So there's just a ton of information that you don't have at the outset. You can issue spot, and we do, and predict what the defense is going to say, which is why it's helpful that we're both former defense lawyers in large part, and play out the string to the best of our ability. But when you have such limited information, you're not going to get it right every time, even though based on the information that you have at the time, you believe that there's a substantially greater chance of winning than not. Does that make sense?
No, it totally does.
And I think in the same way, just because, when I was on the defense side practicing, I fortunately won a lot more cases than I lost, but in the ones we lost, I would never say that our defense was meritless. It was just.
I would, you got to believe your own case. Trust me. I would. Yeah, I'm kidding.
It's
sort of.
Yeah. There's a lot of uncertainty in litigation.
It is. Yeah, it's difficult. And like juror number 3 didn't like us, or, hey, look, I worked on a case once and it was about, we lost the contract because of you. And, what came out in discovery was in the bidding process before the interference, the other client had already been picked, right? So did X happen? Yes, X happened. What is the unknowable that 3 years into discovery after the Rule 45 subpoenas or whatever it is, they weren't going to pick you anyway. Sorry. So, and that's true. And, I'll say this. Many of the cases I would assume you guys are funding, even though the claim holder is your counterparty, they are law firms that, if they wanted to, could risk $4 million on the case themselves, right? I mean, some of them are very large law firms. So there's sort of that interesting dynamic, because what Matt was saying is we do take a lot of risk. And I think that's borne out in the fact that the lawyers taking in the fees, they could be fronting them on a full contingency if they wanted to, but they choose not to.
Yeah, let me say a couple of things about that. But first, let me say a couple of things about that. First, you were talking about meritorious cases. We only fund cases that we strongly believe to be meritorious as a factual matter, as a legal matter, and as a sort of equitable and thematic matter. This is one of Stewart's great emphases in our team meetings is, the story, the equities. If this goes to a jury, who's going to, we learned as trial lawyers, the winner in a trial is often the person with the best story. And we back people who really have been wronged, and who have suffered injustice or at least, inequity. So that's another important part to bring up in addition to legal and factual merit. Sorry, I lost my train of thought. I said I was going to follow up on what were we talking about just a minute ago?
Well, on the law firm taking the risk.
Oh yeah, I wanted to say that. That was on the short list for answers of like what has surprised you or what have you learned in this business. One thing that I really learned, didn't understand at the outset, and have come to learn is that a law firm being willing to do something on contingency is not equivalent to a funder being willing to fund, and shouldn't be. Lawyers have, every law firm's different, every lawyer's different, so I'm painting with a broad brush, but particularly pure plaintiff firms who do things on contingencies, my view is they oftentimes, not all of them, but a lot of them sort of operate more on a VC model than a private equity model, or you're playing with your own money model, which is to say they can take flyers and often do, because it's their time. And also one thing that I see often is they can kind of get the gut feeling that there's enough value at the end of the case, at the end of the rainbow, that it's worth them putting their time into it and doing it, but they can't explain exactly what that value will be, or they can't and don't substantiate it. So I actually think that the calculus around contingency fees are oftentimes very different than the calculus that funders do. Now, again, there's a spectrum. I think that when you have a very conservative law firm like the one that Stewart and I came from, and they agreed to take a bigger discount than they typically take, particularly in the state of affairs in American litigation, that is an indication that a bunch of really smart and risk-averse partners looked at this case and believe in it. And it probably made it through a contingency committee that's more, that's as rigorous as our underwriting. So that is a major signal. But if a firm that is accustomed to doing a lot of cases on pure contingency does a case, that doesn't mean that it's very likely to win. That means that firm is willing to put a bet down on the table.
Right, and I think too, in a firm like you guys are Williams and Connolly, obviously a massive defense firm, and so the opportunity cost, as well as these 4 associates who are going to grind on this for 2 years, could actually be billing out at 85% of their rate and getting paid every month. So I agree. All right, so
there's so many internal dynamics at firms, and especially larger, kind of any firm, I don't know, over 50 lawyers, where sometimes they're just not built to take contingency cases. They're not built to carry that cost. Or, I hear so many lawyers just say they want funding because it's really awkward if they take it on full contingency and they've got to show up at the partners meeting for the next 2 years, and there's a big zero on the case. They just don't want to have to deal with explaining to the partnership why they're sinking all their time and money into this.
Right. Yeah. No, I think that's absolutely right. Is that, in some of these firms, I think the schism you see is, especially when the economy is booming, right? The transactional partners, they never discount, right? They never discount. They bill the full rack rates. And the second thing is they get paid every single month. Whereas in a contingent fee case, it's, we're either on a full contingency or partial contingency. Or if it's a funded case, we're working at a huge discount. And from a business perspective, they're saying, well, like, great, we might win $30 million in year 4, but what about today? Because I might not be here in year 4. All right, Stewart, I have one more for you because I want to ask you again. There's obviously law firms you want to be doing business with. You go to the conferences, you go to the lunches, you go to the meetings, you do your thing, you develop that business like the pro you are, and finally, a matter comes in from a law firm you want to work with, and you all look at it, and it's going to be a no. Tell me what that's like for you, because like if you were in software sales, right? They'll buy the licenses to this. So the weird thing about BD, and I found this at Bannon, is you're trying to get it in the door, and then you get in the door with with somebody that's not going to work. So, what's sort of your approach to that?
Yeah, those are not the most pleasant conversations to have, but I think I take the approach of being direct, being quick, and doing it over the phone or in
person. You give them a maybe, like within 5 minutes, right? And
yeah, exactly.
Like,
give us a month to think this over, and we'll come back to you.
And then we'll think of some stupid questions for you, and maybe you could come back and answer those and write another memo before I say no. Yeah.
I mean, the quick is probably the most important. I think a lot of lawyers just want an answer. They want a yes or a no. And part of what our model is based on and kind of our business process is trying to turn around a quick kind of green light or red light within about 48 hours of seeing a complaint or talking with the lawyers about a case. And if we're going to be a no, you try to be quick about it so you're not dragging them along and wasting their time. You be direct about it of just here are the issues we spotted. And again, it often will say no. Even the case might be great, really strong in the merits, facts and law, but maybe it's the damages aren't there, or maybe there's one legal issue that is an unsettled question of law, and we've got to wait and see how the court rules on a motion to dismiss. But I think for the most time, lawyers appreciate if you're direct with them about what the issues are, if you're quick, and then if you do it over the phone. I mean, I'm a strong believer in just picking up the phone and talking to people. I find that to be a lot more effective than sending an email.
Yeah, and that's why I don't pick up your calls. Usually. Guys, we have 1 minute left. So in the last minute, I'm a company or I'm a lawyer. What do I really need to know about what is a special sauce? With you guys, like what is a special sauce? Do you think?
It's Matt. Matt's the special sauce.
It's good. Good.
I was going to say Stewart.
That's good.
No, I think it's. Go ahead, Matt.
Yeah, sure. Sorry, Ted, do you mean in terms of how to get a case funded with us or just sort of what is the nature of our business?
Yeah, well, just sort of like, look, I can work with a bunch of people. Like, let's say I have a good case and it's a $4 million budget, right? Like, what's why do I want to call you guys? How does it work? What's the differentiators?
Because we are working with us is going to be like working with top flight lawyers in the sense of responsiveness and client service. You'll be on a Zoom call with the entire firm quickly. We respond to emails, we respond to phone calls, we pick up the phone. We care about sort of the user experience. We don't have layers of bureaucracy. We don't have steps up the ladder that you have to get up until you finally get to some mysterious investment committee that then sends down a couple of questions and you go back around the circle again. Working with us is like working with a team of lawyers and finance professionals who care about your case and care about the sort of experience you're having, the user experience with us. That's been a critical part of our ethos since the day I joined is treating people like you would treat a client at a Williams & Connolly. Respond to emails, respond to calls, communicate, and treat people with respect and respect their time and be efficient. And, I think some people some do, some don't like the value add in terms of having some, 4 reasonably seasoned lawyers taking a really hard look at a case and asking all the tough questions and talking it through. I think some people really appreciate that. And again, you're dealing with us. We're a team of 5, including Richard Greenberg, who's has had an incredible long career in litigation. And I think that, when we fund a case, we become part of the team. If you want us to be, we can be, silent in the sidecar, or, just along for the ride, or we can be a real part of the team. And either way, we're going to make sure to be professional and respectful of our counterparty and of their times and of their cases, and just hopefully be a positive experience to work with, which is sometimes what I hear about other funders, but sometimes it's not. Stewart, you agree with?
Yeah. How do I find you, Stewart? How do I get in touch with you guys? Are you on the trail, like in the fall? You at the conferences? Like, what's the best way to find you?
The conference circuit, the website, LinkedIn. Going on with what Matt said, I think it's the client experience. We get back to counterparties right away when they reach out to us. We move things along really quickly, and then I think there's kind of certainty and reliability. And when we issue term sheets, we've got a track record that we're going to close on those term sheets, and we're going to stick with the terms in those term sheets. And I think that certainty and reliability matters a lot when you've got a client in the midst of litigation and they need to get financing lined up to be able to see it through, and the lawyers don't want to have to be spending tons of time finding the financing. And we're going to be able to help get that done quickly and efficiently.
Also, our fund is discretionary, so we get to make the decisions. We don't, underwrite something and then go out and look for the money, which is another story that I sometimes hear. I'm sure that's never happened to you, Ted. But
well, I know. Well, as I say to people, we're only to go out to people who have the money, and then if they say no, we'll go out to the people who have to find it. We need to start with the people who have it on the ballot. I say we're only going to talk to the best people until they say no. So, all right. Well, guys, this has been really great. Land on a high note. Talk to you soon, guys. Thank you.
Thanks, Ted.
Thanks, Ted.